Hello and welcome to the Cryptoverse 369. I'm your host, Orion, and in this channel, we'll explore the latest in crypto and blockchain, including in-depth chart analysis and world financial news. In my previous video, I explained why I chose to exit the BTC trade early with a small profit. That decision wasn't emotional. It was based on multiple warning signs lining up at the same time. We talked about a potential head and shoulder structure forming. We talked about bearish RSI divergence. And we talked about the open CME gap below price. None of these factors alone guarantee a reversal. But when several of them appear together, the risk profile changes. Looking at price now, we can see why that caution mattered. Bitcoin failed to push higher and instead rotated lower, validating the decision to step aside. This is an important lesson. Exiting early doesn't mean the trade was wrong. It means the market stopped offering favorable conditions. Trading is not about squeezing every possible dollar out of a move. It's about protecting capital when probabilities shift. By exiting early, I kept flexibility. If structure improves again, I can always re-enter. And if downside continues, I'm already out of the way. This is why risk management matters more than prediction. You don't need to be right about direction. You need to be right about when to stay involved and when to step aside. Small profits protected are better than large profits hoped for. And discipline always pays over time. Hey, if you feel like diving into crypto yourself, I've put a few links in the description where you can get started safely. It won't cost you anything, and it's just a little way to say thanks. Think of it as a small bonus for watching. I also want to mention something important about the weekend. While Bitcoin was moving into a more uncertain structure, there were still short-term opportunities on other pairs. I took a few short-term trades over the weekend, and they played out well. But it's important to understand how those trades were managed. Short-term trades and long-term positions should not be mixed. They have different goals, different risk profiles, and different management rules. Personally, I keep short-term trades and longer-term positions on separate platforms. This avoids confusion and emotional interference. That way, I can manage short-term volatility without affecting my long-term thesis. And at the same time, I can hold longer-term positions without reacting to every small move. This separation is especially important during volatile or unclear market conditions. It allows you to stay flexible in the short term, while remaining aligned with your broader view. One platform, one strategy, one mindset. This is how you avoid selling long-term positions out of short-term fear, or holding short-term trades out of long-term hope. Trading becomes much clearer when each position has its own purpose. One last thing I want to add. At the same time as I stepped out of the BTC trade, I was still holding other positions, on different timeframes and with different intentions. For example, I'm holding a long-term ETH position, while also managing short-term positions on other pairs. This is why separating strategies matters. A short-term BTC short doesn't cancel a long-term ETH thesis. And a long-term position shouldn't be closed just because a short-term setup changes. Mixing timeframes creates emotional decisions. Separating them creates clarity. Different assets, different timeframes, different platforms. That's how I stay flexible without contradicting myself. This approach allows me to protect capital in uncertain conditions, while still participating in longer-term trends when structure supports it. Trading isn't about picking one direction and sticking to it no matter what. It's about adapting without confusion. Clear structure, clear risk, clear mindset. Thank you for watching. Don't forget to like and subscribe for more updates, chart analysis and insights, and feel free to comment below.